Have you ever wondered what happens when entrepreneurship, environmental sustainability and venture capital collide? If so, you're like me and you're in the right place. Welcome to The Green Adventure. On the show, you'll learn from the critical insights of both founders and investors alike. Not random advice or generic guides, but real stories born out of their experience with genuine climate action. We aspire to create a network of people collaborating to build the green economy, accelerating us towards this critical target of net zero emissions. I'm your host and founder of the show, Jake Woodhouse. For all the notes, links and episodes, please visit www.greenadventure.com. Take care when typing that in. Adventure is spelt with a double D. Thank you for listening and enjoy the episode. Today we feature Rodney Schwartz, founder and CEO of ClearlySo. ClearlySo is Europe's leading impact investment bank, who've cultivated a fantastic network of like-minded people, helping to finance many successful cleantech startups. Listen to Rod's story to gain insight on how failure is part of the journey, how your mission can be driven from your nearest and dearest at home, and how investing with impact can be more competitive than the traditional capitalist model. Rod's vision is truly inspirational, and I hope you enjoy learning from one of the most influential members of the London impact investment space.
Hi, Rod. Thank you so much for coming on the show.
Hi, Jake. Pleasure to be with you.
Great. So my first question today is really to help the listeners understand who you are and your current role. So please could you give us a bit of an overview on what you currently do?
Okay, so my name is Rodney Schwartz, and I am the founder and chief executive of a company called ClearlySo. ClearlySo is Europe's largest impact investment bank. So what does that mean? It means we do all the things that investment banks do, like provide corporate finance and advisory and capital raising services. But every single client we work with is doing something good for society. It might be social, it might be ethical, it might be environmental or sustainable, but it's some way that we can get what is an existing sort of system, the capitalist system, to work in a way where society benefits at the same time as people are benefiting. Does that help?
That summarizes very nicely. So we had a quick chat before the conversation now, and I first came across ClearlySo when I was looking for an early stage angel network here in London that would supply some deal flow to invest into specifically environmental companies. But yeah, no, you guys have a great name in the marketplace, and it's great to spend some time with you today and learn about the business. So thank you.
Happy to do that. I mean, environmental companies are probably our biggest sector, together with the health tech sector. Mm-hmm. But as you know, with our 800-person individual network, we cover the waterfront. Any sector, education, health, environment, transport, there are so many sectors, and there are many business models that deliver what we call impact to society, beneficial or positive impact to society. Obviously, there's lots of companies that deliver negative impact to society, but sadly, we don't want to. Sadly, that's true, but we don't want to muck around with those.
Okay, and so the social impact investment space, from a very high level, what are your reasons for creating an investment business in this space? Of course, returns drive everything, but are there other reasons as to why you're interested in the space and as to why those returns are created due to the social impact lens you're using? Does that make any sense? So more like a thesis. What's your rationale for being in the space?
Well, I mean, there's always a personal rationale. Mm-hmm. So I had some ill-gotten skills, which I acquired in investment banks of a more mainstream nature. We can talk about some of those names, like Lehman Brothers, which almost brought down the global financial system, but also some other names that I worked with. And I guess as I was getting older and my children were getting older, and I had to explain to them what are the things in life that matter, the contrast between how I lived my life and the things I told them were important became so great that I felt I had to close the chasm or cross the chasm. So I felt that I could no longer carry on doing what I was doing and, then espousing ethical views to my children, which I did nothing to live. And I think children, especially when they get to a certain age, but at a very young age, understand the difference between what parents say is important and what parents do that acts as a role model. So for me, the main motivation was to do something that my children would be proud of. And I didn't have a business model. I didn't have a business idea. I just had guilt and a desire to make my kids proud of me. And that's what actually led to the development of ClearlySo. I mean, there's more to that story, which if you like, we can elaborate on now.
Of course. It's always fascinating when you hear, of course, so to be clear, I'm looking to talk to you today to speak about what it's like to think and be an investor in the social impact space, and specifically the sustainability side of things. But you're also a founder yourself. So there's kind of two angles to it. And really good entrepreneurial opportunities often come from personal pain points.
Yeah.
And that's almost exactly what you're describing here. So perhaps you can take a step back in time. And so how long ago was it when you first looked at creating more of a social impact?
Well, I felt guilty for a long time.
Finance space.
I felt guilty for a long time, but I suppose that somewhere around 1999, I decided that I needed to do something. And it took me a while to figure out what to do, Jake. So I'm not one of those people that had the good fortune to see it
the light moment
and see clarity. Exactly.
So often the case as well. People always tell you, "Oh, I had this light bulb moment," and actually, it takes years to have that.
I did not. So after my career in investment banking, I ran a fintech VC firm called Catalyst, and I won't elaborate on that unless you want me to. But a couple of years in, I thought, "Oh my God, I really want to do something much more impactful." And let's use that language. So I started what I describe as my journey from the dark side, which I think captures it quite well. So we tried to see if we couldn't raise a fund that would, at the same time as it would deliver returns, would back businesses, it would deliver some benefit to society. So our first idea was organic food. Our second idea was human capital development or education. Our third idea was the environment, and we actually bid for a firm, which I'll go into if you're interested. Then we won a competition to run a fund working together with The Big Issue and Gordon and Anita Roddick from The Body Shop. And all of that happened in that 3 or 4 or 5 years, and it all failed.
Wow. And so this was 99 to around 2005.
This is 99 to 2003 or 4, where we tried a number of things and they all failed. And then I thought, okay, I can't raise a fund that will do this, but maybe what I can do is use my skills, because venture capitalists often say to people, our money, that's not the most important thing. It's all the skill and expertise and contacts and connections we will deliver to you. So I thought, well, if that's true, then I still have all those other things. So let's just try to I thought I'd fling myself about and see if I couldn't be of some help. So I got involved in 2 roles at the same time, which were very, very different and actually led to the creation of ClearlySo. One was at a large national charity called Shelter, where I became chair, and I was there for 14 months. It was a very miserable experience. I felt it was inefficient, bureaucratic, and poorly run. And I could do very little to change it because of the board dynamics. So eventually I quit in frustration. So not a good experience. But sometimes the bad experiences are as instructive as the good. So at the same time, I also became chair of JustGiving, which at that time was a small company run by 2 women, which made it quite unusual. Had maybe 7 or 8 people. It was losing a fortune. But I thought this business has the potential to be massively disruptive in a sector that needs disrupting, the charitable sector, needs to lower its cost of raising money. And this could be a great business. And what I did thereafter is thought, I know what I need to do now. What I need to do is start a company, the purpose of which is to help create 100 JustGivings. So the motto for ClearlySo was create 100 businesses that can be disruptive, positively impactful on society, and really great businesses. And when I say great businesses, I mean it in the financial sense. JustGiving exited at 20 times what investors entered at. So I made 20 times my money. And by anybody's standards, that's a great investment.
Return, yeah.
So I thought if we can do that 100 times, then, I can die with a clear conscience.
Gosh, Rod, thank you so much for sharing all that. There's so many things you're touching on that I'd love to open up about, but I guess we've only got a little bit of time. So when you mention the dark side, it's that search for your own mission. Like, what are you passionate about that is just so important in your own career? Whether you're a founder, whether you're an investor, whether you're just an employee. I personally was working with the fossil fuel business for many years. And for me, the interest in clean tech comes out of that, about the genuine insight that you get and how the world's currently functioning, how you'd like it to change in the future. And you also mentioned failure. Well, some people really mention the most important thing about entrepreneurship is actually just resilience, the ability to just get up and go again. And actually, success is achieved by people who failed the most. Funnily enough, it doesn't feel like it when you're failing, but no, that's fantastic. Okay, so you wanted to create 20 JustGivings.
100.
100 JustGivings.
We've probably done about 20.
Fantastic. And so, okay, to talk specifically about ClearlySo at the moment then, thank you for sharing the personal journey, so to speak. From an investment perspective, how do you create deal flow? So you mentioned as a VC network so important. Well, as a quite specific question, how many companies do you guys see, if you're able to reveal that? Or equally, how do you foster a network of incentivized people to share their investment opportunities with you?
Yeah, so we probably see about 1,500 deals a year, and that number is going up. And if we wanted to, we could easily double that figure. It's just a bit of a macho figure at this stage for us. As the leading impact investment bank in Europe, we find that we don't have to work to get that kind of number of inflow. We find that by far and away, though, the best quality deals are not the ones that come to us unless they come through people we know. So other companies we've helped, when they recommend us, we know they're really good leads. Other investors we work with, when they recommend us, we know they're good leads. We have some deal flow partners we've worked with over the years. But to address one aspect of your question, we don't incentivize them at all. So people, I think, in the mainstream say, oh, this is one of these impact things. I better just take it to ClearlySo, or I'll send them to ClearlySo. So we haven't found to date, I think we've ever had to pay an introduction fee. We'd be prepared to. On one or two occasions, we looked at some things that had fees attached, but by and large, we find that people just know that we do this, that we're the only people that really do this at scale. And we get a massive amount of deal flow from our angels. And as I said, there's about 800 in the network, from some of our institutional investors, from clients we've helped, and we've helped about 150 over the years. So that's where we get deal flow.
Awesome. So it's in a sense, it's all of those personal touch points that you've created over the last 15 years that help to create a warm introduction environment that's, really critical in this area.
It's almost 20 years. In fact, it's probably almost 20 years to the day.
Well, since 1999, it is.
Exactly. Yeah. So, and I guess if you put yourself about a lot, and if you hold conferences, which we did, if you speak at a lot of events, if you have blogs and social media and all these things, people find you. And we've been doing this for, like you said, 20 years.
No, fantastic. It's a funny one, the paid for opportunities. I've personally been working this space for only a couple of years, but you get this kind of corporate broking model where people are trying to take a percentage of the money raised, etc. And I'm not convinced it creates the right incentivization model to build genuinely sustainable and good companies. But yeah, that's just my opinion. So we no need to expand on that. To move to another area I'm interested in, often these are businesses that have only just started making revenue. They're not necessarily profitable companies when you're looking at such an early stage.
Yeah.
Risk. How do you start to quantify risk when you're looking at investments and advising clients as to what are good opportunities? Is there any insights you can share for those listening out there that an investor will look for or will avoid, etc.?
In the impact space, I'm coming to the view that it's less risky. So if we look at the deals we've done, at the stage we've done them at, far fewer seem to fail than in the mainstream. And that's odd.
Interesting.
And surprising. I think there's a reason for that. I think when people are involved in an endeavor that has a higher purpose than just making money, it's not to say making money isn't really important, but when they're trying to do something that is in addition to making money, they stick with it longer and people give up on it less quickly. And investors back it and support it more consistently than they would if it were just a money-making play. Because you do something in the purely money-making world, it doesn't work. You just close it up and do something else.
Yeah.
But when you have beneficiaries, homeless people, young kids trying to get an education, people with autism. It's just a lot harder. And as a result, the failure rate is lower. So I think from a risk perspective, it's actually less risky. The second thing I would say is we do not do very early stage deals. Okay. So we don't do seed, we don't do startup. Yep. Any company that comes to us usually has traction, revenues, it may not be profitable, traction, revenues, and just evidence it could work.
Yeah, it's that kind of very early traction that's super exciting. As an entrepreneur, as an investor, you can see there is proof that people actually want to buy this idea that has been developed into a small product. And there's a small there is a de-risking element to a little bit of traction. I totally agree. Okay. And so moving on from that wider risk question, one of the things I wanted to learn when joining the Green Angel Syndicate myself was the due diligence process that an investor goes through. I tried on my own. I looked at 50 entrepreneurs. I was thinking, how do I homogenize value across these 50 opportunities, and looking at, problem, solution, market size, team, exit. There was just so much to talk about, to learn about, depth to go into. You mentioned 1,500 deals arrive on your doorstep per year. Well, how on earth do you get through the due diligence for all of those businesses effectively? Is there any, tips or insights you can share around that?
Well, I'm afraid I'll have to break this down in two questions.
Sure.
So the first question is, what do we do as ClearlySo, which I'll address? And the second question, Jake, for you and your audience, is what do I suggest you do
please.
As individual investors? For us, it's very easy to get from 1,500 down to 200. We just take some simple metrics and apply them. And we might miss something in the 1,300 we cull, but we don't lose a lot of sleep over that. A simple one would be, is it based in a country we can work in? Have they revenues? Do they have whatever? To get from 200 to the 40 we work with in a year is really hard, and we do intensive due diligence, and it will reflect all the elements that you're familiar with. I do have a bit of advice, and that's based on my experience in my current role, my experience in my prior role, and my experience as an equity research analyst, which is that the key to the success of a business is typically not the 1,000 things people look at and tick a box with. It's simply the people. And are they not a dream team, because no team is perfect, but Manchester City might be an example, but do they have in the team, and I use the word team rather than management, and I'll explain in a second, do they have the team to execute on the vision as stated? And the best indication of that is that people have done this before. It's cheat, because it's like, if you've done it before, you'll probably be able to do it again, or something comparable or something similar. And when I say team, I include the board, because I think for early stage companies, the board and the management team can be quite interchangeable. But it's not just, do they as individuals seem to have the requisite skill set, will they play well together? Are they a functional team or a dysfunctional team? And I'm always surprised by how little time people spend on the people. They all say that they back the individual, they back the team, but their due diligence is always nonsensical legal and financial bullshit that actually isn't going to deliver value. But
as a founder, you're making up the expected market. Sometimes the project is completely new. And it's okay, interesting. Yeah.
So
you're helping me out here, Rod, because
great.
My next area I wanted you to explore around was talent. And it was a simple question as, how do you spot the best founders?
Well, we don't need to spot the best founders. I mean, again, to carry on with the football analogy, I mean, you could, Manchester United has arguably the best player in football, but Drogba hasn't really delivered. So it's not about finding the best individual. It's about creating the best team that works together in a way that makes them each able to achieve far more than they could as individuals. And that's sometimes hard to figure out. You have to really ask questions. Are they singing from the same hymn sheet? Do they appear to get on with each other? What kind of backgrounds have they got together? Is there any background stuff that, maybe is lurking? So it's that's a bit harder, but I think that's what I really look for, which is this, because you know what? You're going to get a business plan, and it is absolutely certain that the business, if it's successful, will not look like that business plan. So the question is this a team?
It's crazy, isn't it?
Well,
give me some money for this future scenario that definitely won't exist, but I'll make it happen.
Yeah, but we all know that. So I don't spend a lot of time on business plans because you can pay some crappy accounting firm to do it for you. Sometimes you pay more, sometimes you pay less, sometimes they're nicer, sometimes they're less nice. But you know that that's not going to be the plan. You have a broad sense of the market that they're going to be operating in. But I want to know, are these people going to be people who are diverse, get on well, and have some of the elements, both from a personality standpoint, but also from an experience standpoint, that will enable them to pivot appropriately and successfully when they inevitably do.
And you use a phrase there, pivot. This is something that those that don't operate in the startup space won't necessarily understand. But essentially, business plans, they have to change. They have to evolve. And your customer that you think you're going after sometimes isn't the customer at all. And you find out where actually they are and you start to get some early traction. And it's always fascinating watching early stage teams do that.
Well, can I give you an example?
Yeah, please. Yeah. I was going to ask you to give one. Yeah.
I mentioned JustGiving, and let's just stick with it for a second. So I was chair in the early days. And in the early days, their thought was the customer is the person who gives money to charity. So we'll spend a lot of money acquiring these donors, and that will be the key to success. That did not work. Then we thought, well, maybe the customer is a charity that people give to. So let's invest our time, money, and effort to go after these charities. That didn't work. There was a thought that corporate customers and payroll giving might be the kind of way in, because you'd obviously approach that market very differently. That didn't work. So through trial and error, but open inquiry, you certainly can figure out what's not working. In their case, they eventually did hit upon the real customer, who is the guy or gal who runs the marathon and signs up or sends emails to 400 of their friends to give money. If you can appeal to them and make the experience easy for them, then maybe 5% of their 400 signs up. But that means 1 turns into 20, turns into 400, and you get real virality. And it was only when they figured out that they really needed to key in on the fundraiser, as they call it, that the business just took off. And every company needs to ask carefully who their customer is, and not just develop information that supports their pre-existing bias, but interrogate that question in a very open way.
Yeah, it's the process of killing assumptions.
Yeah.
It's been a really interesting theory to learn about in this space, and it helps to completely disaggregate what's the real data you're interested here and go after the correct customer. So, yeah, the next area I'd like to talk about is really about some of the companies you've actually been working with recently. I personally focus on the sustainability area as the main challenge I'd like to be involved in solving, and some of the companies that you've recently helped to raise money, I'd love you to expand on a bit.
Yeah, let's do that. I can think of a few examples, unless you have.
Well, I have some just written down here
I may not have been involved in them, but carry on.
Well, I read about an indoor farming project called Lettus Grow that I understand you're recently involved in, and also OddBox, which is a waste food project, shall we say.
Yeah.
The reason I bring those two up being the recent, let's say, epiphany that food is one of the largest drivers in sustainability puzzle. And when you're interested to have a look, I mean, Project Drawdown, have you had a look at this? The Paul Hawken book. Issue number 3 and 4, the best in the 100 top toolkit, shall we say, to reduce climate emissions, is looking at helping people transfer to a plant-based diet and also reducing food waste.
Yeah, food waste. And I think we waste.
These two companies are really in this space. I think it's fascinating. So I'd love to know your thoughts on those particular businesses, and it's a good example of what ClearlySo helps to finance.
Thank you. So I understand that 30% of food is wasted.
Correct. Yes, it's one of the stats that people talk about. Yeah.
I never know how they figure these things out, but let's assume it's going to be broadly right. And certainly, if you think about your own kitchen, it doesn't seem completely off. Well, anyway. I was going to give you, in fact, those two examples because they're both recent.
I've done my research.
They're both recent and they're both interesting. But I was also going to give you a different type of company first.
Okay.
So if it's all right with you,
share away.
Let's come back to that. So because I think in this area there are two types of opportunities. One of the really big opportunities to change the system at scale, and one are the smaller opportunities, which might get really, really big. But you're still in the experimental phase. And the ones you've mentioned are in the latter Let me just touch on the former first. So we started to look at the environmental sustainability area. And the first major client we helped raise money for in this area is Upside Energy. It's a company that does sort of battery storage and smart grid management, all these sorts of sophisticated things that I really don't understand. But because we were able to raise them, I think 5, 6, 7, 8 million, something like that, it put us on the map. And we were then approached by Bulb Energy. Bulb is a provider to retail customers of 100% renewable energy. They came to us when they were really small and said, basically, we've got 18,000 clients and we want to grow really fast and we need £1 million. By the end of our work with them, we raised them almost £36 million of debt and equity. And our angel investors invested at a pre-money value of a post-money value of 60 million, 60, which I thought was rather pricey. But in the end, 14 months later, there was another round where they raised 60 million at a post-money value of 411 million pounds. So that was a pretty quick, at least unrealized profit for some of our angel investors. So you can identify opportunities like that at scale. And we've just actually helped Tonic Energy, which is a competitor to Bulb, raise 13.3 million predominantly from Mitsui, the Japanese industrial company. So that's one type of sustainability play. You have to have deep pockets and in some cases, patience. On the other end of the spectrum are these more experimental companies like OddBox and Lettus Grow. Mm-hmm. Lettus Grow, broadly speaking, is in the kind of hydroponic space. We don't have enough soil, so let's be intelligent about how we deliver nutrients and water to plants and dramatically increase yields. And we've helped them, and they're great, and we love them. OddBox is a completely different kettle of fish. So they know that British customers in particular, or probably the supermarkets, are really ridiculous about the sorts of things they'll throw away. So, we moan about the EU, but if apples aren't red enough, if bananas aren't the right shape, ridiculous things go into eliminating produce. And OddBox simply takes that produce and delivers it to actually firms like us. So we are an OddBox consumer. Lots of companies across the country consume OddBox. And it's very simple. It's fruit that would go to waste. And it tastes the same. It's no worse for you. And OddBox reduces food waste, which is great. And the food tastes just as good.
Such an awesome oversight on some really, really impactful companies. And that actually, as a comment, would lead to another area I'm interested in, which is, do you guys follow with any metric whatsoever the actual impact that your financings have? And I saw a statistic online that suggested you've helped raise around £250 million in the impact space here in Europe. So £250 million, fantastic amount to have helped get into businesses like this. Presumably you're calculating not just financial return, but also impact as a impact-driven business. Could you talk to us a little bit about that do you have an internal metric that you help to decide whether or not something's the right thing to look at, or just your own, kind of measurement process?
Sure. So because our reputation is 100% around impact, we obviously could not conceive of working with a client which isn't delivering impact. So we have an 8-page test that we apply to every business that we look at. And if a business doesn't score above 50, we don't take it on. Now, I know that doesn't mean anything to your listener, but we have a test which is around what the business does, who it does it for, where it does it, all the obvious questions you'd ask. And we rate the businesses on different questions. We would love to measure the impact of the businesses that we do. And we would love to combine that so that we could measure our impact. Nobody appears to be prepared to pay for the cost of assessing that impact. So people talk about its importance, but you really need to employ somebody to do that. And we have the tools to do it, but nobody wants to pay for it. And given that, we think, let's just focus on raising the money for now. And maybe there will come a day when people will care enough to actually pay for this, because we can't assess the impact for free. The second thing is, for us as a business, how do we aggregate all that impact? We think it's impossible, because what it would mean is that we have to go into every company and assess the impact and then add it all together. Then let's go back again to the case of JustGiving. So JustGiving raises money for tens of thousands of charities. If you were to measure their impact, they'd have to understand the impact.
It's more than a full-time job, Rod, that's for sure.
I'll say. So we've decided to cheat and say that there's some correlation between the amount of money we help people to raise and the impact they create. And we don't go any further, which is a cheat, but that's what we do.
Well, I think it's safe to say, sitting over here, that there's very clear impact being made by the operation of ClearlySo. And some of the stories you've mentioned and shared today, along with some of the businesses that you guys have within the portfolio that you've helped. We've got time for one last question. This is really just around the future. We don't know what's going to happen, but we have hopes and dreams. Could you share a little bit about where you'd like your business to be in, say, 5-10 years' time, and the kind of thought process that you put into making these milestones actually happen, if that makes sense?
Yeah, it makes sense. I don't think our business will be fundamentally different. It will be more geographically dispersed. We have already done that to a degree. So now 2/3 of our institutional investors are outside the UK, across Europe. We might extend that a bit further. As I mentioned, we brought Mitsui into Tonic. The companies that we're working with will be more geographically dispersed. I think we've done 3 or 4 out of the 170 deals that have been from outside of the UK. But in our last angel event, 2 out of 3 were from outside of the UK. 1 Spanish, 1 Dutch. So I think there will be a more international business. And the larger investors that we work with, particularly outside of the UK, want to have a geographically diversified portfolio. And it won't surprise you or your listeners that the UK isn't top of everybody's list anymore. So I think that for reasons that address investor concerns and also our own business sustainability, we are looking beyond the UK. We're legally permitted to do so. I think that we're just a small company, so we're only 20 or 21 people. So we have to be realistic about what we can achieve with 20 or 21 people. I used to be an analyst of investment banks, and I've seen them blow up. And when they do blow up, it's because they get ahead of themselves. What I would say, just to be a bit futuristic about impact, is that I think that investors are increasingly looking at every investment and every company from not just the perspective of their previous 2-dimensional analysis, where they think only about return and risk. I think so many investors are now thinking about risk, return, and impact. I think that impact will be part of most investment processes in 10 years. I think governments will increasingly internalize externalities. So companies that do bad things will find themselves charged for it. Companies that do good things may find themselves getting a credit for it. And I think the whole nature, not the nature of capitalism will change, because capitalism will be like it's been, but some of the thought processes that go into investment decision-making, I think will change as this third dimension to investing becomes more and more important. I think tax policy will drive that. I think consumer behavior also drives that. People are increasingly buying fair trade goods, and fair trade goods offer no advantages at all. They don't taste better. They're not better for you. They're just paying more money to the workers in poorer countries. And people aren't forced to buy fair trade. They just pay 27% more on average for goods. And in a world where people are willing to embed ethical preferences into their consumption decisions and also investment decisions, will be a very different world from the world of today.
Fantastic. Well, thank you so much for sharing all your thoughts today. And great to meet you. Thank you, Rod.
Nice to meet you, Jake. Thank you.
That was The Green Adventure. Thank you for listening. If you enjoyed the show, then please help us out by sharing this episode with your networks and rating us on the platform wherever you may listen in from. For any questions at all, we'd love to hear from you, so please reach out on social media or email. Whether you're wondering about a technical term that's been discussed, would like an intro to a guest from the show, or even perhaps feature yourselves, we're here to help. My Twitter handle is @JakeWoodhouse, spelled as it sounds but drop the final E. My email, jake@greenadventure.com. Remember, that's ad spelt with 2 Ds. Finally, for the notes, links and episodes that will be coming, visit www.greenadventure.com. Remember, that's ad with a double D. Until next time, we'll be back soon. Thank you and goodbye.